The Federal Reserve has finally acknowledged what many in the investment community have been saying for months. The U.S. economy is not recovering. Ben Bernanke and company moved to keep interest rates at historic lows and encourage economic growth. And policymakers signaled that they would take even more aggressive steps if the job market and other indicators continued to weaken. Behind these moves is fear. Fear of what Japan has been battling for 2 decades and the U.S. economy hasn't faced since the Great Depression: deflation. Over the past 12 months, core retail prices have risen less than 1%, the smallest increase in nearly 50 years. That's well below the central bank's inflation target, and it's causing a shift in philosophy away from the Fed's traditional focus on inflation. But why is deflation an even more fearful enemy? How can we fight it? Those are questions our guests will answer this week on Money and Markets. Tony Sagami tells us why we should heed the warnings from what used to be the world's second largest economy. And we'll get concrete investment ideas for dealing with deflation. First up, Mike Larson, followed by a special roundtable of asset managers. Mike Burnick of Weiss Capital Management, John Browne of Euro-Pacific Capital, and Sherman Goodrich of Franklin Templeton Investments. All that and a final comment from Martin Weiss coming up right now.
From our studios in Jupiter, Florida, Weiss Money Network presents Money and Markets. And now, Jamie Holmes.
Hello, everyone. The Federal Reserve's recent moves have put financial advisors on alert that it's time to protect against the threat of deflation. Joining us to explain exactly what they're guarding against is Mike Larson. He's the interest rate and financials analyst at Weiss Research and the editor of the Safe Money Report. Mike, thanks for being here.
Glad to do it.
Mike, what warning signs do you see that the economy is indeed in danger of deflation?
Well, Jamie, they're the same signs I've been warning about for months. Many of the same indicators that are pointing to a double-dip recession can also be interpreted as deflation warning signals. You mentioned the weak consumer prices. Well, the Conference Board's index of consumer confidence is also tanking, and along with that, so is consumer credit and retail sales. But there are warning signs in other parts of the economy, too. First, the numbers on the labor market, including long-term unemployment, are horrible. Second, manufacturing data from around the country is continuing to decline. And to top it all off, the weekly leading index from the Economic Cycle Research Institute is falling off a cliff, as I pointed out before. With slowing growth comes a rising risk of deflation. But, you know, it's not just the economic data. I'm also seeing warning signs in the markets.
Okay, what are you seeing specifically in the stock market?
Well, Jamie, the warning signs are clearest in 3 sectors that were propped up by the government's stimulus spending. That would be banking, housing, and retail. I mean, take a look at the KBW Banking Index, or BKX. It recently dropped below both its 50-day and its 200-day moving averages. Moreover, it's flirting with a major support level around 46, and I think that technical support's going to break. Now, in the housing sector, the economic numbers have been pointing lower for months, and housing shares are starting to follow suit. The same goes for consumer discretionary stocks, retailers, and things like that. All heading lower. And there are warning signs outside the stock market as well.
I'm guessing here you're talking about bond market as well, right?
Oh, right. I'm paying very close attention to the bond market, and that's where I'm seeing the most dramatic signals of deflation. You know, over the past few months, there's been a virtual nonstop rally into treasuries as investors look for safety. The yield on the 10-year note, for example, has dropped from just above 4% at the beginning of April to under 2.7% now. More importantly, the spread, or the difference between 10-year and 2-year treasury yields, has collapsed. That's a textbook recession indicator, and it's also one of the best market-based indicators of deflation, or at least disinflation. And on top of that, it's bad for the banks because it cuts into their profit margins.
Okay, the question everybody wants to know, how can investors protect themselves against deflation?
Sure, it's a fairly simple strategy. First, short the stock market, especially financials and real estate. You can do that easily with inverse ETFs. Or, if you're not that aggressive, just sell out of what stocks you own and raise cash. Other options, you can bet on increased volatility, or you can even consider getting long the dollar as a hedge.
Okay, thanks, Mike. Stick around a little bit. We're going to bring you back in just a few moments here to discuss that strategy even more. First, though, we're going to talk a little bit more about what deflation actually looks like and how it can impact not only the broader economy, but our everyday lives. Japan has been grappling with deflation for 2 decades, and it offers a frightening object lesson. Joining us with a closer look at Japan's economy and its similarities to our own is Tony Sagami. Tony is the Asia specialist for Weiss Research and the editor of the Asia Stock Alert newsletter. Hello, Tony.
Hi, Jamie.
Tony, why is Japan's economy such a mess?
Oh gosh, a lot of it is because of what the government's done. Back in 2000, the Japanese Federal Reserve Bank lowered interest rates to effectively zero back in 2000. So it's run out of monetary bullets to stimulate its economy. At the same time, they went on massive public works projects and for the last 20 years, and that hasn't worked. The result is that the Nikkei was at 39,000 back in 1989, but today it's less than 10,000. That's a 75% haircut.
Okay, so what's happening here? What exactly is Japan's economy facing right now?
Oh, the big problem is that prices are falling all over the place. The Japanese Statistics Bureau reported that consumer prices have fallen for 12 months in a row. Land prices are roughly half of what they were 20 years ago. And since 1997, wages have fallen by 10%. I think the best evidence is the yield on the Japanese 10-year bond has fallen below 1%, and that's a 7-year low.
Okay, so you think something similar can happen here in the United States?
Oh, you bet. The Federal Reserve Bank has painted themselves in the same corner by lowering interest rates down to zero. And the Obama administration is following a similar path by spending billions, and it's neither creating jobs or stimulating the economy. The U.S. does have a couple advantages over Japan, though. Number one, Japan has an aging population, and with that, improvements in productivity are difficult to get. And number two, the Japanese education system just doesn't produce the technology geniuses that the U.S. does.
Okay, so based on what you've seen with what's happened in Japan over the past 2 decades, what do you think we're going to see in the U.S. economy if deflation actually takes hold?
Boy, you're going to see some rising unemployment, even higher than today's already too high rate. Wages are going to continue to fall. And I think you're going to, more importantly, see declining asset prices. And I'm specifically talking about stocks and real estate. I wouldn't be surprised to see the Dow Jones drop back down to its 2009 lows, and that would put it around 7,000. And I think that's going to happen in the next 12 to 36 months.
Okay, Tony Sagami, thank you for joining us, Tony.
Anytime, thank you.
Deflation would certainly be painful for the economy, but it would also present an opportunity for smart investors. Coming up next, Mike Larson will be back to tell you how to protect yourself from deflation and even profit from it. Then a bit later, we're going to be joined by a roundtable of experts that explain how they're putting that strategy into action. And as always, we want to hear from you. If you have questions about this week's show or suggestions for topics that you'd like us to cover, just email us at weissmoneynetwork@weissinc.com. Money and Markets, we'll be right back.
America is in trouble. Federal and local governments owe over $123 trillion. New debt is escalating at the rate of $183 million per hour. That's $1.6 trillion per year. Bond prices are plunging, and that could drive interest rates sky high, triggering an even deeper recession. If you are worried, and you should be, download Mike Larson's blockbuster new report with urgent investment recommendations to help you protect your wealth and profit. Don't delay. Do it now.
With risks on the rise, you need investment advice you can trust now more than ever before to help protect your wealth. At Weiss Capital Management, we've been managing money professionally for over 25 years and specialize in protecting your investments in turbulent times. Call now or visit our website to get our free special report, Global Credit Crisis Act 2, the steps you need to take now to help protect and potentially grow your investments.
Welcome back to Money and Markets. As you know, deflation can be incredibly destructive to a country's economy, as Japan has found out the hard way. It can diminish nest eggs and other investments as asset values decline. And it can create a vicious cycle as consumers stop buying goods that they think will just be cheaper tomorrow. But there are ways to beat deflation. Joining us again to outline his strategy is Mike Larson, the interest rate and financials analyst at Weiss Research and the editor of the Safe Money Report. Mike, thanks for being here again. Mike, what is the first thing that you would advise investors to do if they see deflation coming?
Well, first of all, Jamie, I tell them to bet against the sectors of the stock market that are going to take the biggest hit during a period of deflation. One of those sectors, of course, is banking. And if you own a stock in any individual bank, it's time to get out. The same goes for ETFs that focus on the banking industry, such as the Financial Select Sector SPDR, ticker symbol XLF. Within the sector, regional banks are likely to suffer even worse losses than the giants of the industry like Citigroup and Bank of America. So I'd stay away from the regional bank holders ETF, ticker symbol RKH.
Okay, so would you recommend the other side of that trade then, namely buying inverse ETFs?
Oh, absolutely. Instead of shorting individual stocks or sectors yourself, you can buy exchange-traded funds that do it for you. The one that targets banking stocks is the ProShares Short Financials, ticker symbol SEF. But there are inverse ETFs for virtually every sector of the market, and that includes another vulnerable group, real estate. As I said earlier, it's already in big trouble, and deflation or a double-dip recession would push housing prices down even further. So the ProShares ETF that shorts that sector would also be a good bet. And a third sector I think will get hammered is retail, specifically consumer discretionary stocks. I mean, in a deflationary environment, consumers are going to hold off on buying items they don't need. So I'd look for ways to short those shares as well.
Okay, what would you tell investors to do in the bond market?
Well, I don't think the bond market rally is going to turn around anytime soon, so I certainly wouldn't aggressively short treasuries. But I'd also be wary of jumping on the bandwagon after such a rally. The thing to do, frankly, might just be to sit on your hands. To illustrate my point, look at this ETF that buys the mid part of the treasury curve, the 7 to 10-year notes. This thing is up 10 points in price in just the last 4 months. So you always have to be careful when you see a move like that.
Okay, what about bonds outside of treasuries?
Sure, I think it's a good idea to sell your riskier, higher yielding bonds because those tend to trade with stocks rather than treasuries. There are a couple of popular ETFs that invest in junk bonds, one of which is the Spider Barclays Capital High Yield Bond Fund, ticker symbol JNK. I'd say investors should dump those kinds of holdings because they're more tied to credit risk than interest rates.
Okay, I've also heard about another type of bond called strips. Those are supposed to protect against deflation. What is your take on those?
Sure, that's a very aggressive play. Strips are zero coupon treasury bonds where the fixed rate is locked in and automatically reinvested. Yes, they're a hedge against deflation, but they're the absolute highest risk, most turbocharged way to play a rally on the long end of the curve. And like I said, given the rally we've already seen in treasuries, I'm just not willing to tell people to take that kind of risk right now.
Okay, Mike, is there anywhere else that you'd put your money besides betting against stocks?
One word, Jamie, cash. Even in the event of deflation, it's a relatively safe play for people who are concerned about return of their investment rather than return on their investment.
Okay, Mike Larson, always a pleasure.
Thank you.
Coming up next, we're going to see how money managers are putting these deflation strategies into actual action. We'll be joined by Mike Burnick of Weiss Capital Management, John Browne of Euro-Pacific Capital, and Sherman Goodrich of Franklin Templeton Investments. And coming up a bit later, a closing comment from Martin Weiss. Stay with us on Money and Markets.
Hi there, this is Mike Larson, editor of Weiss Research's Safe Money Report. You can't just focus on stocks anymore if you want to be a successful investor, and you can't just focus on the United States either. You need to know what's going on in Asia, which Tony covers. You need to know what's going on in hard assets like oil and gold, which Sean and Larry are on top of. You need to know what's happening in currencies, the specialty of Brian Rich. You also need to keep abreast of the best ways to build wealth in an era of near 0% interest rates, and that's what my colleague Nilis Mativ covers. And of course, you need the top-down, big-picture analysis that Safe Money delivers to you each and every month. Best of all, the Weiss Elite membership gives you access to all of that and more. The Weiss Elite gives you the tools and knowledge to profit from all of these market developments. Now, I may be biased, but I think it's a no-brainer, and I'm glad you're one of the smart investors who recognizes that fact. Thanks for your time.